Markets open in hours. Silver closed Friday at 77.69. And the next 72 hours are going to tell us everything we need to know about whether this consolidation is ending or just beginning. I'm tracking 5 specific signals in real time. And by the end of this video, you're going to have the exact playbook for what to watch, what it means, and how to position yourself before the crowd figures it out. This is John A.G., and I spent the weekend analyzing every data point, every historical precedent, and every market signal that matters right now. Because here's what most people don't understand. Markets don't move randomly. They move based on specific triggers, specific patterns, and specific conditions that repeat throughout history. And when you know what to watch, when you know which signals actually matter, you stop reacting emotionally and start positioning strategically. If you want real-time intelligence on what's actually happening in silver markets instead of just price commentary and hype, subscribe right now. And drop 72 hours in the comments so I know you're tracking this with me. Because what happens this week could define the next major move in silver. Let me show you exactly what I'm watching. Silver closed Friday at 77.69. Gold closed at 4,166. Let me give you the context for why these levels matter. Silver is trading in what technical analysts call blue sky territory. That means we've broken through 45 years of resistance. The old ceiling at $50 from 1980, the attempted breakout at $49 in 2011, all of those psychological barriers have been shattered. We spiked to $121 in late January, then crashed to $63.90, and now we're consolidating at $77. This is not random price action. This is a market digesting the most violent move in modern silver history. When you go from $25 to $121 in a matter of months, then crash 48% in a week, the market needs time to figure out what's real and what was speculation. And right now, that's exactly what's happening. Silver is building a base, it's testing support, it's shaking out weak hands, and it's preparing for the next move. The question is, which direction? Here's why $77 matters. It's roughly the middle of the current trading range. Support is at $64, resistance is at $90. If we hold above $77 through this week, that's bullish. It means buyers are stepping in. It means the floor is holding. It means the market is coiling for a move higher. If we break below $74, that's a warning sign. It doesn't mean the breakout failed. It doesn't mean the bull market is over. But it does mean the consolidation could extend. It means more time, more volatility, more testing of support before the next leg begins. And if we break above 83, 85s with strong volume, that's your signal. That's the market telling you the consolidation is ending and the next move toward $90 is starting. Now let me show you the 5 specific signals I'm tracking this week. The first thing I'm watching when markets open Monday is whether silver can hold above 77. This is the midpoint of the range. It's where the market closed Friday. And it's the line in the sand for this week. If Monday opens at $78 or higher, that's immediate confirmation that buyers are present. If it opens at $76 or lower, we're testing support, and we need to see if 74, 75 holds. Here's why this matters psychologically. Markets remember price levels. Traders who bought silver at $77 are watching to see if they made a good decision. If price immediately drops below their entry, they panic. They sell. They add to the selling pressure. But if price holds or moves higher, they relax. They hold. And new buyers step in because they see support holding. This is not abstract theory. This is how markets actually work. Human psychology creates support and resistance. Fear and greed create the patterns. And understanding those patterns gives you an edge. Now here's the historical context. In the 2008-2011 silver bull market, there were multiple consolidations. Each one looked like the top. Each one created fear, and each one was followed by new highs. In early 2009, silver consolidated between $11 and $14 for months. Everyone thought the rally from $8 to $14 was over. Then it broke out and went to $18. In mid-2009, it consolidated again between $13 and $15. Same story. Fear, doubt, boredom. Then it broke out and went to $20. In 2010, another consolidation between $16 and $19. Same pattern. Then it exploded to $30. Every single consolidation was followed by continuation. Every single time, the people who sold during the consolidation missed the next leg, and every single time, the people who accumulated during the consolidation were rewarded. So when I see silver at $77, consolidating after a violent move, testing support, I don't see fear. I see opportunity. Because this is what bull markets do. They shake you out, they test your conviction, they make you doubt, and then they leave you behind. The second signal I'm watching is volume. Specifically, volume on any move toward $85, because price can lie, volume doesn't. Let me explain what I mean. Price can move on thin volume. A few large orders can push price higher without broad participation. That's a weak move. It's not sustainable. It gets reversed quickly. But when price moves on heavy volume, that's real. That's broad participation. That's institutions, hedge funds, and retail all moving in the same direction. That kind of move has legs. It continues. So if silver moves from $77 to $82 this week on light volume, I'm skeptical. It might be a head fake. It might be short covering. It might be a temporary squeeze that reverses. But if silver moves from $77 to $82 on heavy volume, that's confirmation. That's the market telling you the buyers are real. The demand is real. And the next move toward $90 is starting. Here's how I'm quantifying this. On a normal day, silver futures volume on ComEx is around 80,000 to 120,000 contracts. During the January spike, volume exceeded 300,000 contracts. That's panic buying, that's mania, that's unsustainable. During the crash, volume also spiked above 250,000. That's panic selling, forced liquidations, margin calls. Now, during this consolidation, volume has dropped back to 100,000 to 150,000 contracts. That's more normal, but it's still elevated compared to the quiet periods before the breakout. What I'm watching for is this. If we get a move toward $85 on volume above 180,000 contracts, that's significant. It means new buyers are entering, it means the market is building momentum, and it means the probability of a breakout above $90 is increasing. If we get a move toward $85 on volume below 120,000, I'm cautious. It could be a false breakout, it could reverse quickly. Volume is the truth serum of markets. Price can be manipulated. Volume shows you where the real money is going. The third signal I'm watching is the ComEx inventory report that comes out Friday. This is one of the most important data points in silver markets right now, and almost nobody's paying attention to it. Here are the current numbers. ComEx registered inventory, which is silver available for immediate delivery, stands at approximately 32 million ounces. That's down from 45 million ounces at the start of January. In 1 month, 13 million ounces were withdrawn. That's a 29% decline in available inventory in 30 days. Now let me show you why this matters. ComEx is where paper silver trades, futures contracts, derivatives, bets on price. But those contracts are supposed to be backed by physical metal. When a contract expires, traders have the option to take physical delivery instead of rolling the contract forward. Most traders don't take delivery, they just want price exposure. They trade the paper. But when physical demand increases, when investors lose faith in paper markets, delivery demands spike. And when delivery demands exceed available inventory, the exchange has a problem. In January, delivery demands were massive. 33 million ounces were delivered. That's more than the entire registered inventory we have right now. JP Morgan provided 99% of those deliveries from their massive stockpile. Everyone else had nothing to deliver. So here's the question. What happens in February? February is another delivery month. If demand matches January levels, ComEx doesn't have enough registered inventory to meet it. They would need JP Morgan to deliver again. Or they would need to change the rules. And that's exactly what I'm watching. This Friday, we get the weekly inventory report. If registered inventory continues draining, if we drop below 30 million ounces, that's a crisis signal. It means the physical shortage is real, it means paper markets are losing credibility, and it means price has to rise to reflect reality. If inventory stabilizes or increases, that eases the immediate pressure. It gives the market breathing room. It suggests the shortage was temporary. But here's what history tells us. In 2008, during the financial crisis, ComEx faced delivery stress. Inventories were draining, traders were demanding physical, the exchange was on the edge of default, and silver prices spiked as a result. In 2020, during the pandemic, the same thing happened. Physical demand overwhelmed the system, premiums exploded, vaults were emptied, and spot prices had to adjust to physical reality. We're seeing the same pattern now. Inventory draining, physical premiums elevated, paper-physical disconnect widening, and Friday's inventory report will tell us if the pressure is building or easing. The fourth signal I'm tracking is silver lease rates. In my last video, I explained what lease rates are and why they matter. If you haven't watched that video, go back and watch it because this signal is critical. Quick recap, lease rates are the interest rate someone pays to borrow physical silver. Normal lease rates are 0.51%. During stress, they rise to 5 to 8%. During crisis, they go above 20%, and right now lease rates are at 39%. 39% means banks are desperate to borrow physical silver. They're willing to pay insane rates just to get metal for a short period. This happens when there's a severe physical shortage. When vaults are empty, when paper shorts need to deliver against obligations and can't find metal. The last time lease rates hit 40% was May 1999. That spike led to the Washington Agreement in September 1999, which restricted central bank lending of precious metals, and that triggered a multi-year bull market in silver. The last time lease rates exceeded 30% was October 2008 during the financial crisis. Silver bottomed 1 month later, then rallied 450% over the next 2.5 years. Both times, lease rate spikes preceded major bull markets. Both times, the signal was clear, physical shortage. Both times, investors who understood what lease rates meant positioned themselves before the crowd. And now, lease rates are at 39% again. This is the third occurrence in modern financial history. And the pattern is repeating. So what I'm watching this week is whether lease rates stay elevated or start declining. If they stay above 30% through this week, it confirms the physical shortage is real and worsening. If they drop below 25%, it suggests the immediate crisis is easing. As of Friday, lease rates were still at 39%. I'm checking daily. And if they're still at crisis levels by Friday, that's a major bullish signal. It means the underlying stress hasn't resolved. It means banks are still trapped. And it means the squeeze is still building. The fifth signal I'm tracking is physical premiums in Shanghai and Dubai. These are the markets where the East buys physical silver. And right now, they're paying massive premiums over Western spot prices. Here are the numbers. Shanghai is paying approximately $35 to $42 over ComEx spot. Dubai is paying $35, $40 over spot. Japan is paying 60% plus premiums. These are not small differences. These are massive disconnects between paper price and physical availability. Let me explain why this matters. In a functioning market, when Shanghai pays more than New York, arbitrage traders step in. They buy silver in New York at $77. They ship it to Shanghai. They sell it for $119. They pocket the $42 difference minus shipping costs. That's free money. But that arbitrage isn't happening. Why? Because either they can't source physical silver in New York to ship, or they can't get the metal into China due to export restrictions, or the logistics are so constrained that the profit disappears. Any of those explanations is bullish. If you can't source metal in New York, that's a supply shortage. If you can't ship to China due to restrictions, that creates two separate markets with two separate prices. And if logistics are the bottleneck, that's a temporary issue that eventually resolves with higher prices. What I'm watching this week is whether these premiums persist, expand, or compress. If Shanghai is still paying $35 to $40 over spot by Friday, that confirms the East is aggressively accumulating physical metal. If the premium compresses to $10 or $15, it suggests demand is cooling or supply is increasing. This is a real-time indicator of physical demand. Paper markets can be manipulated, physical premiums can't. They reflect what real buyers are willing to pay for real metal in the real world. And right now, the real world is paying $35, $40 more than the paper price. That's not normal, that's stress. And stress creates opportunity. Let me give you the hour-by-hour playbook for Monday specifically, because the first day of the week sets the tone. Sunday night, Asia session. Silver starts trading in Asia around 6 p.m. EST Sunday. Watch the opening price. If Asia opens strong, above $78, that's bullish. Asian buyers have been the strong hands in this market. They buy physical, they don't trade paper, so if they're bidding aggressively, that's real demand. Monday morning, European session. Europe opens around 3 a.m. EST. Watch for volume and direction. European traders tend to follow Asia's lead. If Asia was strong and Europe continues higher, momentum is building. Monday, 8 a.m. EST, US pre-market. This is when US futures markets get active before the official open. Watch the $77 level closely. Does it hold? Does it break higher? Does it test lower? Monday, 9:30 a.m. EST, US stock market open. This is when correlations matter. If the stock market opens weak and silver stays strong, that's bullish. It means silver is acting as a safe haven. If stocks rally and silver rallies with them, that's also bullish. It means risk-on sentiment is supporting commodities. Monday, 10:30 a.m. EST, economic data. Check if there's any major economic data releases. Fed speakers, inflation reports, employment data, these can move markets. If data is inflationary, silver benefits. If data is deflationary, silver might pull back temporarily. Monday, 1 to 2 p.m. EST, midday assessment. By early afternoon, you'll have a clear sense of the day's direction. Is silver holding above 77ers? Is volume elevated? Are we seeing follow-through, or is the move fading? Monday, 5 p.m. EST, close. The closing price matters psychologically. If silver closes above $78, that's a bullish start to the week. If it closes below 76 ooks, we're testing support. This hour-by-hour framework isn't about day trading. It's about understanding market flow. It's about seeing where the real demand is, and it's about positioning yourself ahead of the crowd. Now let me show you what happens if silver breaks above $80 this week, because $80 is more than just a round number. It's a psychological level that signals momentum. If we break $80 on Monday or Tuesday with strong volume, here's what that tells you. The consolidation might be ending early. Buyers are stepping in before $90. They're not waiting for confirmation, they're positioning ahead of the breakout. In that scenario, $85 becomes the next target. And if we take out $85, there's nothing between us and $90 except air. That's when FOMO starts. That's when retail investors who sold at $70 start panicking to get back in. That's when momentum accelerates. But here's the key. It needs to be on volume. A move to $80 on thin volume is a head fake. A move to $80 on heavy volume is real. Historical context, in the 2010-2011 silver bull market, every consolidation breakout started with a move through a psychological level on heavy volume. When silver broke $20, it went to $30 in weeks. When it broke $30, it went to $40. The pattern is consistent. So if we see $80 this week on strong volume, I'm watching closely. That could be the early signal that the next leg is starting. Now let me show you the other scenario. What happens if silver breaks below $74 this week? First, don't panic. A break below $74 doesn't invalidate the bull market. It doesn't mean the breakout failed. It just means the consolidation needs more time. In that scenario, we're testing the 64.70 support zone. That's where the real buyers are. That's where institutions accumulated in early February. That's where smart money is waiting. If we test 64.70s again, watch the reaction. Does it bounce immediately? Does it hold for a few days and then bounce? Or does it break through and test lower levels? A strong bounce from 64.70 confirms that support is real. It gives the market another opportunity to build a base. And it sets up the next attempt at $90. A break below $64 would be concerning. Not catastrophic, but concerning. It would mean the consolidation could extend for months instead of weeks. It would mean more volatility, more pain, more testing of conviction. But even in that scenario, the long-term structure is still bullish. We're still in blue sky territory. We've still broken 45 years of resistance. The fundamentals haven't changed, only the timing. Now let me tie this back to the prediction I made in my last video. I said February 15th is a critical date. If lease rates stay above 30% through February 15th, we'll see one of four outcomes by March 1st. ComEx rule changes, government intervention, China export policy modification, or silver above $150. Today is February 9th. We have 6 trading days until February 15th. And the signals we see this week will determine which scenario plays out. Here's the scoreboard right now. Silver, 77.69, consolidating in range. Lease rates, 39%, crisis level, unchanged. ComEx inventory, 32 EMM to Oz, still draining. Shanghai premium, 35 DAF, 42s, elevated, persistent. Physical availability, mints still suspended. Dealers still defaulting. 4 out of 5 signals are screaming shortage. Only silver price is consolidating. That's a disconnect. And disconnects don't last forever. They resolve. Either the physical signals ease or the price adjusts to reflect reality. Over the next 6 trading days, we'll find out which one happens. And the 5 signals I just gave you are how we track it in real time. Let me tell you what the smart money is doing during this consolidation, because this is where wealth is transferred, from the emotional to the rational, from the reactive to the strategic. Smart money is not trying to trade the range. They're not trying to catch the exact bottom or sell the exact top. They're not using tight stop losses that get triggered by noise. They're not over-leveraged. What they're doing is accumulating on weakness and holding for the breakout. They're watching the same 5 signals I just showed you. They're tracking lease rates, inventory, premiums, volume, and price action. And when those signals align, when the data confirms the thesis, they act decisively. They understand that the downside is limited. $64 is strong support. Even in a worst-case liquidation event, $55 is probably the floor, but the upside is open-ended. There's no resistance above $90 except the $121 spike, which was an outlier. Beyond that, it's blue sky, so the risk-reward is asymmetric. You risk $15, $20 to the downside. You gain potentially 5,100 plus to the upside. That's 3.1, 5.1, maybe 10.1 risk-reward, depending on where you enter. That's how professional traders think. They don't try to predict exact tops and bottoms. They assess probability, they size positions based on risk reward, and they let the trade work. Let me be transparent about what I'm doing personally. Not financial advice. Just transparency, so you can see how someone who understands these signals thinks about positioning. I have a core physical position that I'm holding regardless of short-term volatility. Physical silver is not a trade. It's long-term wealth preservation. I don't sell physical based on daily price moves. I'm watching this week's price action to determine if I add to that position. If we test $70, $75 on this consolidation, that's a gift. That's an opportunity to add at excellent risk reward. If we break above $85 on strong volume, I'm not chasing. I'm holding what I have and watching for the next consolidation to add more. I'm checking lease rates daily. I'm checking ComEx inventory weekly. I'm monitoring Shanghai premiums. These are the signals that matter more than the spot price. And I'm prepared for volatility. I'm prepared for 64. I'm prepared for 90. I'm prepared for chop. Because I've thought through the scenarios, I have a plan for each one, and I won't be surprised by anything. That's the difference between prepared investors and reactive investors. Prepared investors have plans. Reactive investors have panic. Here's your framework for the next 72 hours. Print this out, save it, check it daily. Monday, watch if $77 holds. Watch volume on any move toward $80. Watch for momentum building or consolidation extending. Tuesday, watch for follow through. If Monday was strong, does Tuesday confirm? If Monday was weak, does Tuesday stabilize? Wednesday, midweek is often when the direction becomes clear. Are we building a base for a breakout, or are we setting up for a test of support? By Thursday, you'll know which scenario we're in. And by Friday, when the ComEx inventory report comes out, you'll have concrete data to confirm or deny the thesis. This is not about predicting the future. This is about tracking signals, understanding patterns, and positioning with probability on your side. There are 3 types of people watching this video right now. The first type will watch, find it interesting, and do nothing. They'll check silver prices every hour. They'll get emotional about daily moves. They'll react instead of plan. And they'll miss the opportunity because they were too busy watching to actually position themselves. The second type will get overwhelmed. Too many signals, too much data, too much complexity. They'll freeze. They'll wait for more clarity, more certainty, more confirmation. And by the time they're certain, the opportunity will be gone. The third type will use this framework. They'll track the 5 signals. They'll watch the hour-by-hour playbook. They'll have a plan for each scenario. And when one of those scenarios starts playing out, they'll act decisively while everyone else is still trying to figure out what's happening. Which type are you? Markets open in hours. Silver is at 77.69s. And the next 72 hours are going to give us critical information about whether this consolidation is ending or just beginning. I've given you the 5 signals that matter. Support at $77. Volume on moves toward 85. ComEx inventory on Friday, lease rates still at 39%, and physical premiums in Shanghai and Dubai. I've given you the hour-by-hour playbook for Monday. I've shown you what happens if we break $80 and what happens if we fall below $74. I've connected it to the February 15th prediction from my last video, and I've shown you how smart money is thinking about this moment. Now it's your turn. Watch these signals, track the data, have a plan, and don't let emotions make your decisions. Drop 72 hours in the comments if you're tracking this with me. Subscribe if you want real-time updates as this week unfolds, and share this with someone who needs to understand what's actually happening instead of just reacting to price. This is John AG. The next 72 hours matter, the signals don't lie, and the opportunity is in front of you right now. Watch, track, position. And I'll see you on the other side of this week with an update on what actually happened.